During the last decade, the investment world has seen some of the most stellar performances ever from several asset classes and even the appearances of new ones, creating new millionaires overnight through the exchange of digital assets. Looking back at the best performing asset class since 2010, we can spot two clear winners in cryptocurrencies and big tech. Although almost every asset class did considerably well, with exceptions like commodities, which didn't tick up until 2021's inflation crisis. Nevertheless, if you happen to be invested in the early 2010s and held your positions with nerves of steel, congratulations. If you're not a millionaire by now, you certainly became a lot wealthier. Since the aftermath of the Great Financial Crisis, we've seen some paradigm changes disrupting traditional correlations between macroeconomic variables and asset classes. For example, central bank interventions in the bond market through its quantitative easing programs have led to misprices of sovereign debt and extreme volatility inside the repo market. In the corporate world, stock buybacks have become the new vehicle used by public companies to return capital to the shareholders, as they are perceived as more tax effective than a dividend payout. This reward system has pushed stocks, especially tech stocks, into exorbitant levels, defying even the fastest interest rate increase since the late 1970s, with the Big 7 tech stocks jacking in an average of 55% year-to-date gains. Indeed, markets have reached such levels of exuberance, it's hard to believe the winner of the next 10 years will be the same as in the past. For instance, while there is no doubt about how good of a company Apple is, once the $3 trillion market cap milestone is reached, another $3 trillion are needed just to double your investment. Apple and other like Microsoft, Google or Amazon have already become some of the largest stocks in history, and although this doesn't mean they can't keep growing further, due to the law of diminishing returns, it is statistically unlikely they'll be able to match last decade's gains. After last year's crash in the markets when the Federal Reserve began quantitative tightening, and despite the recent recovery, many have started asking themselves which could be the next best performing asset for the next decade. When people endeavor themselves into risking their capital, as a general rule, non-speculative investment decisions are made through a reasonable combination of risk and reward, and this simple technique of picking good businesses at reasonable prices has proved capable of achieving great results. Many investors still believe they will be able to front-run their competitors in the race to discover the next Bitcoin, NFT, or AI leader of the future, and we should not blame them for it. They have been proven right to do so recently. However, after the paradigm changes we explained before, I would like to introduce you to a third and key one for this video. Fighting climate change, increasing sustainability, promoting diversity, and responsible governance have become the core principles of ESG. A couple years ago, rating companies started creating score tables grading corporate behaviors and how they impact society and the environment. Some rating agencies focus more on climate change and practices like the use of water, renewable energy, or land, while others give more credit to corporate governance, diversity in the workforce, and involvement in charitable foundations and other social issues. Nevertheless, ESG took off, and today it's one of the leading thematics in financial markets, especially thanks to asset management firms like Blackrock, Vanguard, State Street, or MSCI, who have cashed in, offering clients a variety of ESG-themed ETFs. The involvement by governments and international organizations has been and continues to be one of the main drivers in financial markets, even leading to the creation of new markets. This was the case in 2005 when the European Parliament introduced the EU ETS, better known as the International Emissions Trading System, or in other words, the carbon credits market. This new market out of a sudden set a limit on the total amount of CO2 which could be emitted into the atmosphere by a country inside the Union, forcing big companies to acquire carbon emission rights in order to avoid economic sanctions for exceeding their emission limits. The system is called cap and trade. Depending on the nature of their operations and their effects on greenhouse gas emissions, companies can receive carbon emission permits for free, while others are forced to acquire them through auctions or from other companies with excess of credits. For example, combustion car makers need to acquire most of their permits, while companies engaging in renewable energy have received them for free. The amount a company can receive in free allowances is calculated based on its historical average emissions. If the company is able to find greener source of energy, this creates a financial incentive for the company, as it will be free to sell in the secondary market its remaining carbon credits. Each year, the amount of allowed emissions and credits is reduced, therefore further incentivizing firms to continue pushing for lowering their emissions. However, the system has not proven as effective as expected, given that the biggest European polluters have been receiving almost 100 billion euros in free permits during the last 10 years to prevent relocation of their facilities to countries with softer policies regarding the environment. Airlines, oil refiners, car makers, steel manufacturers, and other highly pollutant industries have been the biggest beneficiaries of free carbon permits in Europe, which is not how it is supposed to be. However, this hasn't stopped other countries from copying the idea, and today China, Canada, the United States, Switzerland, and South Korea also have their own carbon credits market. In the United States, only one state currently operates a carbon emissions market, which is California. The Californian carbon emissions market started in 2013. It also emits free allowances for greenhouse emissions, and by the end of 2022, the program had raised $22 billion, which have been transferred to the Greenhouse Gas Reduction Fund. It has been made notorious the specific case of Tesla Motors, who is one of the firms who have benefited the most from selling its excess carbon credits. The Californian state, through its 2017-2025 emission standards known as LEV 3 standards, set the allowed emissions by car depending on the model and year of fabrication, between 213 and 144 grams of CO2 per kilometer. Without any need to make a calculation, it's obvious for all of us, sticking to the driving emissions, EVs emit considerably less CO2 than gasoline cars. Therefore, Tesla has been receiving billions of dollars in CO2 credits, which has later been selling to other car manufacturers for a direct profit, mainly to Chrysler. However, there is one type of business in the United States which could benefit so much from this system that buying their public stock today could very well be the best investment decision for the next decade. Trees. Buying trees as investments is not a new idea. Indeed, it's an idea as old as humans have walked the earth. Trees are sources of food and timber, but they are also the key of every land ecosystem, with nature flourishing around them. In the United States, a company willing to invest in real estate can acquire the status of REIT, or Real Estate Investment Trust. REITs have special status in which 90% of taxable income is required to be paid to shareholders as dividends, and in exchange, they pay no corporate taxes. There are many types of REITs: residential REITs, office REITs, data center REITs, but also Timber REITs. Timber REITs are real estate companies which acquire acres of land to grow trees and exploit them in a sustainable manner. They are the largest producers of timber, but they also earn money from hunting permits, recreational activities, and hospitality. Given that this unique business model operates by growing trees, one of the best vehicles for CO2 capture, they could benefit greatly from carbon allowances. The only reason why, so far they haven't, is because there are no timber REITs big enough to qualify for carbon credits in California. But that's not the case in other states. Several companies like Rioneer, West Timber, and especially Weyerhaeuser own assets big enough to be considered as potential receivers of tax credits. To better address the figures, let's pick the example of Weyerhaeuser, who by the way decided to start selling promises on its carbon credits this year. The company calculates their timberlands can absorb 17 million metric tons of CO2 per year. With the price per ton of CO2 oscillating around $15 per metric ton, that will bring in $231 million per year, only by selling their carbon credit allowances. However, factoring in the reduction in business activity from chopping down timber, the company estimates the immediate profit estimation is closer to $100 million. Nevertheless, with decreasing carbon credit allowances per year and new caps on emission limits, some estimations suggest the future price per metric ton of CO2 in the US could find new highs in the ranges of $80 or even $100 per metric ton, which would elevate the profit for Weyerhaeuser north of $1.5 billion US. This investment idea is speculative for now, but given companies like Weyerhaeuser are well-established and profitable businesses, investing in Timber REITs can provide you with a good investment return under any scenario, and you also capture the upside of speculating with carbon credit markets. Governments and international organizations have shown willingness to increase the resources in tackling global emissions, and while so far, carbon credit markets have showed mixed results since they first appeared back in 2005, it would not come as a surprise if the remaining states of the Union would follow California's example, creating a groundbreaking opportunity for America's Timber REITs. This is all for today. Leave your opinion in the comment section if you also believe Timber REITs can become a life-changing investment opportunity. See you in the next one.